All right, guys, welcome again to another webinar. I've got a very special guest and a good friend of mine, Kostas Cavellos. Did I pronounce it right? Cavellos?
Bang on, bang on.
Thought I got it. All right, well, we're here to talk to you about CMHC MLI Select program. And, this program is somewhat complicated to understand, and that's why I brought in an expert to talk about it. What it is, it's a program being offered by the government, and I would say this is a gift from the government, because what it's allowing mom and pop investors, non-institutional investors to do is to be able to buy commercial financing with very little money down, with a lot of protections in place, but it also gives investors the ability to take on more financing. And I know a lot of my clients who were investing in real estate before meeting me, they may not have had the right structure, and a lot of them have hit ceilings in terms of being able to buy properties because they didn't structure through a holding corp and this and that. But what this program does is, because it's commercial, it's a total different process for being qualified for financing, and it really opens up the doors for people to be able to buy and invest more in real estate. And this type of real estate also is backed by very strong metrics that, in order to qualify for this program, it needs to meet a very strict criteria, I should say. So I don't want to take all from your presentation, Kostas, because you're going to get into all of the details of this. But, one thing to keep in mind, that the program is complicated. And that's really why I partnered with you and your partner, Paul, and the builders that you work with, because when you have the right team and you approach us the right way, you're going to be able to, first of all, work with builders that are able to deliver to meet the requirements of the program. But we're also going to help you walk through every single step of this so that you can close on this and, have a great investment. So Kostas has more experience than anyone I know, and he's going to help us source all of these deals and work with us as a team. Again, I don't want to get into too much of it, but some of the special things that you guys have been able to bring to our clients who invested in these products, conditions that are protecting the buyers. It's a secure investment. Money is held in trust. I know that's a big concern when you're tying up money in an investment for 6 months, 12 months, or sometimes even longer. Builders often in this program use your money to build. And one of the great things about the way we've structured this is that money is actually held in trust. So builders are using their own money to build. So, without getting into too much of the details and taking away from your presentation, why don't we jump right in and go through it?
Thank you, Ryan. And to touch on what Ryan said, what we're going to do today is we are going to essentially do a Coles Notes, an introduction to what is a complicated process, but at the same time, like anything, after you've done your first one, it pretty much just runs on its own. It's a well-oiled machine. And what I also want to add is that Ryan is correct in saying that because this is a complicated process, people like myself and Ryan, we decided to merge together. We've known each other close to 15 years, worked together for close to 12. And it is something that, if anyone ever tells you they're a one-man shop in something like this, be wary, because there's a lot of moving pieces. It takes a team. I'm sure everybody has heard that saying, it takes a village to raise a child. Well, it takes an entire team to take one of these from start to finish. And that is essentially what you have here. You have over close to 40, 50 years of real estate investment experience. Ryan and myself, we're more real estate investment consultants than realtors. And what we do is we bring our teams and our knowledge, and we help you get from the start through the entire process and right past the finish line. And when I say past the finish line, you'll understand as we dive in. So again, First Access Realty, that's my company, First Access Condos from before. We've partnered up with Connect, Ryan and his team, and we're bringing you something offered through the government. Not the first time around. It was originally brought to life in the 60s when my people, the flood of the Europeans, came over and the government realized there was nowhere to house them. They created this exceptional program, and it's really a leverage play. It's allowing you, the everyday investor, to take on some financing terms that aren't offered anywhere else. And from my understanding, it's not just anywhere in Ontario, anywhere in Canada, North America, it's anywhere in the world. So this is essentially the best leverage that we can attain as a real estate investor on the planet, and we found a way to customize it to protect you, the buyer, you, the investor. So without further ado or delay, we're going to dive in, and we are investing with the CMHC MLI Select program. So I like to call it the unicorn of real estate investing. So why do you invest in the program? Well, we've been selling real estate investments for over a decade. We learned about the CMHC MLI Select program, and we quickly realized it was a game changer, offering investors strong rental returns in cities with solid capital appreciation, a rare combo in today's market. That's the unicorn. So throughout our years in the pre-construction segment, and that's how many of you probably met us, it was capital appreciation, but no monthly rental returns. And you got the one, but not the other. And then for those that wanted to deviate from the herd and wanted to go on their own path, we could find them properties that offered rental returns, monthly returns, but they would have very little capital appreciation. So I'll give an example. AAA cities like Toronto, Vancouver, you bought a condo, you knew it was going to go up in value, but you weren't going to make anything. You might even lose a little bit every month. And we made a mastery of the ability to explain to clients, losing a little bit of them every month is okay with respect to the big picture. Then on the other side of the spectrum, you had places like Windsor, Ontario, where you would make money monthly, but 10 years from now, your property was probably worth the same amount of money that you bought it 10 years prior. So it was either or, A or B, not in between.
Use the Windsor market as an example because a lot of people were chasing cash flow there, but I'm like, the property never moves. It's right?
And that's a perfect example, and that's why I use it. I had a friend that was, he bought, I believe it was in 2015, he bought something in Windsor. He goes, I'm making $2,000 a month. You're losing money. And then in 2025, last year, we talked about it, and he goes, my property's worth the exact same, maybe a little bit less. Right. So it's either or. But through this program and throughout this presentation, I'm going to show you how we've found a way to do both. I'm going to show you that you can generate the best cash on cash returns from an investment property that you've ever seen, and I guarantee you will question it. And you'll call Ryan's team back and you'll ask for verification. We'll be able to provide that these numbers are real. Okay, they're vetted by multiple segments of the real estate world, but these are real returns. And what we've done is we've picked cities that are currently booming and are forecasted, and economists and myself and Ryan are bullish on. So we found that unicorn, something that does both. Now our overview. Everybody has heard of CMHC. What do we know them as? We know them as the government agency that insures mortgages for people that don't have a proper down payment of 20%. And that's what it is. So I'm starting out, for example, I'm looking to buy my first home. I can't muster up 20%, but I have 5 or 10. What the government does is, because they want to create home ownership, is they insure that mortgage so the institutional lenders will actually give me the loan. But that's not the only side to CMHC. They also have a commercial division, okay? So everyone knows them as a federal program to encourage housing, and they provide financial solutions, including mortgages to insure buyers. It has 2 arms. What I just discussed was the residential division. The commercial lending division is the other little known segment, and that is who we are working with through this program. Its commercial lending division is federally mandated to help build more apartment buildings, more housing. And what we've done is we took a program that was designed to build apartment buildings, and I guarantee you, no matter what city in Canada you live in, if you do a quick drive today and you drive around, you are going to see apartment buildings, purpose-built apartment buildings that look like they were built in the 60s and early 70s. They have a distinct look. Those buildings were almost all exclusively built through this program. So that should help you understand the scope of this program that we're currently working with. Overview. CMHC provides mortgage loan insurance for multi-unit developments to allow for favorable financing options. These tiered incentives are based on affordability, accessibility, and energy efficiency. But for the majority of our investors, and like Ryan said, the mom and top non-institutional investors, and don't get me wrong, together we have sold 6 plexes, 8 plexes, and we're working on a 106 unit building currently. So it goes across the entire gambit of what you can invest. It's all based on what you can afford, okay? But for the majority of ours, we're gonna focus on the affordability tier because the accessibility usually comes in larger buildings as well as the energy efficiency, but we will go over all. Select affordability requirements. It must include an affordable housing component. The affordability is based on market rents and lower premiums for higher affordability benchmarks. So by affordable housing and it being affordability based on local markets, think affordable being calculated at 30% of the median income of an area. So that's what the government thinks an affordable component of your income allocated to rent should be. Now, how do we use this to our advantage? You find markets that have the greatest household income in the country, and that's what we work with. This doesn't mean building slums, and you have to get that picture that comes into everybody's mind when they hear affordable immediately out. It means getting creative through smaller units, higher auxiliary fees, and also where you place these units.
Yeah, that's a key piece, the affordability piece, because some smaller markets, some bigger markets as well, have very high median incomes, and this program works better in those markets. Is that correct?
That's 100% accurate. And what we did is I've got to give some credit and explain this. Before I started diving into this segment, I researched it for 6 months and I traveled across the country. And what I found is 2 markets that we think we are very bullish on for future growth and economic development. And then we also noticed that those 2 markets had the highest household income. And examples of these are Edmonton and Calgary. They have the highest household income in the country. So 30% of their median income is actually higher than places like Toronto or Vancouver. So the affordable component there is actually greater rent than the affordable component here. And what we also did in addition to that is when we did our research into CMHC, CMHC didn't care if the unit was in the basement or on the penthouse. So if you put your affordable component subgrade, okay, you would actually be getting an affordable rent, which was on par with basement rents. So you don't lose any money being part of this program. So the affordable component doesn't cost you anything at all. So what we're going to do is we're going to show you some examples here of our finished product. As you can see on the left, these are standard finishes for us. And I have never had anyone who has visited me who bought and walked through one of these not say that they were extremely surprised at how well they were built and the quality of the finishes and the fit. This is just an example. And any of you that reach out after this and want more questions, I visit our properties about once every month. This has kind of been what I've been doing for the past couple of years. And if you yourself buy one, expect to get monthly construction updates, finished product walkthroughs, and that'll be all secondary when we break down into smaller groups at a later date. And we go over how we've actually designed a contract to protect you and put in certain inspection conditions, timelines for you, the buyer. So these are just examples. And as you can see, this is at par with most condo buildings that are not purpose-built rentals. And even the basement units, they're finished exceptionally as well. There's no deviation from quality based on where it's located in the structure.
Yeah, and I've driven these markets as well and spent a lot of time out west, and you could really notice how much of that housing is still there from the 60s and 70s, and there's definitely a premium for this nicer design. I mean, there always is for new versus used.
And that's what it is. And when I show some of the numbers to people, because they're not used to alternative markets, it's usually just the 2 mainstays, right, on the West Coast and here in the GTA. They're like, I don't know how you can claim to get these rents. And it's quite easy. The affordable rents are based on numbers from Stats Canada, which is essentially, aside from the big 5 banks, the greatest sorts of data in the country. So you have them basically governing what type of affordable rents there are. And then once you physically engulf yourself, walk through these properties, you say, now I can see this is really nice. So remember, when you work with Connect and work with us, all the guessing work has been removed. All the legwork has been removed. We're doing the heavy lifting throughout the process, and we become your partner from start to finish and actually pass the finish line. And by the end, you'll understand why I hyper-emphasize that point. Okay, we can move on, Kayla. Key benefits. Now, this is why we are promoting this type of investment, have personally been invested, and have helped clients buy everything from $2 million to $32 million. Okay, currently, and I'm working on more. The key benefits to the MLI Select program, and when I say MLI Select, notice how I don't just say MLI, because MLI Select is the pinnacle of the options offered from CMHC. And we have, although we can work in any segment, our primary focus is to give you the best, okay? The Rolls Royce of this program, which gives you the following. You have an extended amortization up to 50 years. And to wrap your head around what that actually means, a normal mortgage has a 25-year amortization. 50 years means it takes longer to pay it by twice as long, which means in theory, your payments are cut in half. And if you make an investment and your payment to the bank is half, that extra money goes directly into your pocket. And that's allowed us to get these incredible otherworldly returns. Up to 95% loan to cost. That's financing with as little as 5% down. I am not scared to say this, and I will say this on a pre-recorded webinar, that the majority of our deals finish off between 5 and 5.9% down. And the reason we keep hitting those numbers is because our financial forecast and projections are accurate. And I'm going to touch on that on the second last slide as well. Do not be duped by people that overpromise and underdeliver. We would rather be conservative and impress you more at the end. Okay? Below prime. Go ahead.
Such an important point, and that's what I tried to highlight in the intro, and that's why we put together a team. I mean, there's a tremendous amount of experience in real estate, but in this program, and this program is quite complicated. So I love that, working with you guys know every single step of the process, and it's really been great for our clients.
And that's what it is. And people tell me, and one of the most common questions that is brought up is, we saw another team, and where you're saying you can get 2,400 in rent, these guys are saying 2,800. And I tell them, if we're all renting in the same area, what would make their mousetrap so much better that it's $400 more a month? And the answer is nothing. No one's making this and building it with gold toilets and gold faucets, right? So you really got to be careful, because when it comes to this, there's multiple audits, multiple checks. I'll get into that later, but it is so much better to guarantee you qualify at what you're aiming to put down. You come in, and if you get better rents, I'll show you what we do with that after. There's multiple layers to this cake, and consider it as the ultimate birthday cake. So after the 95% financing, and let me touch on that before I bounce to the below prime interest rates. To buy any investment property in Canada outside of this program, you need to put 20% down, which means you can't get financed for more than 80% of the purchase price. You're getting financed for 95% up to with this program. So you're getting an amortization of 50 years. So your mortgage payments are cut in half, and your deposit is 1/4 of what you would need through something else. So let that sit there and stew a little bit in the mind. That is about exciting as it gets when it comes to real estate. And in addition, you have below prime interest rates. So I don't care who you are. If you've renewed with a fixed rate at your big bank, we're going to get you a better interest rate, because that's what this program does. So you have a below prime interest rate. You're buying with 5% down or close to it, as opposed to 20% down, and you're getting a 50 year as opposed to 25-year amortization. And in addition to that, you get 5 to 10 year terms for cash flow stability. So currently with the bond rate, it's a fixed interest rate. It's based on the bond rate. Currently with the bond rate, we're promoting the 5-year term. But if bond rates continue to fall, because they've been on a downward slide since the start of the year, if they continue to fall, you might be able to get a 10-year mortgage. Imagine getting a 10-year mortgage, what you just got a 5-year on your house for an investment property, and you put 5.1% down.
And what are the rates we're seeing today?
We're seeing high 3s.
Yeah, that's great.
Like, think about it. So a high 3 with something that you have 5% invested in, and you're generating, okay, everybody, I hope you're sitting down, you're generating 18 to 25% yearly cash on cash returns. But we'll put a visual of that so everybody can confirm that's what I actually said. So, okay, so what does this all mean to you, the investor? You guys are our target market. You guys are the people that put your trust in us. And what we do for you through this program is we get you guaranteed high return on investment and positive cash flow. We do both. We get the positive cash flow through the rental returns in comparison to the debt that you have to service. And in addition to that, you get the appreciation because we are working in markets whose population is growing. Even if there's an outflux of migrants leaving the country, according to some news sources, where we are doing this, their populations are growing. They're some of the fastest growing cities in the country, and their economies are also growing at a time where not much is. Okay, the MLI Select program guarantees positive cash flow. Now, as an investment consultant, and Ryan can back me up on this, we never use the word guaranteed because we don't have crystal balls. But this program won't allow you to proceed if you are not generating a minimum amount of profit. So that's how it guarantees it, and that's how we can say it. Legally and professionally, we can use the word guaranteed. Now, how does it do that? Think of a third-party sanity check. So if we're going to promote an investment opportunity to Ryan or myself or the people that work for us, they would review it, and that would be a sanity check, basically check the numbers, make sure it makes sense, it's real, okay? So not only what you see in front of you is not only has it been reviewed by our respective teams, but this will also be reviewed by CMHC and the financial institution that's doing the lending. So that's 3 layers of review, and it has to pass all 3 layers of review. So, and I'll put it into layman's terms. Ryan and I don't want to work on this for 1 entire year for it not to work out for you. The government doesn't want to insure a mortgage that's not going to work out. And the bank most definitely doesn't want to lend up to 95% financing with a 50-year amortization on something that doesn't work out. So we as the investor, we are benefiting by the bank and the government protecting themselves. And then we come in as positive collateral damage. So that's really how you look at it. We are benefiting by safeguards put in place to protect the government and major financial institutions, and that guarantees you making money. So CMHC conducts its own analysis of cost, rents, etc., to determine the cash flow, and the project only qualifies for loans, get ready, when cash flow is 110% of cost. So what does that mean? Is that not only the cost to service the debt load has to be covered 100%, but you, the investor, must be making a minimum of 10% profit. Where have you bought an investment property and made 10% profit? And I'll tell you this, if it's under 13%, CMHC starts to get worried. So guaranteed for us to even propose this to you, we are 100% certain, as much as anyone can be possible, that this is generating more than 113%, which means you're making 13% minimum profit per year.
And that's on the cash on cash side. That's not even talking about the appreciation, which I think we'll get into.
Strictly cash on cash. This is strictly cash on cash is what we're going to be discussing, because the appreciation side, that's something that's kind of an added bonus, okay? But we're talking investment here. We're talking monthly returns. We're talking cash flow in markets that are growing, which will guarantee that capital appreciation. Now, leverage government-backed financing to maximize your investment. That's what we're doing. This is a leverage play, borrowing as much cheap money at the best terms possible. Best terms possible. And when I say that, these are the best terms in decades. Remember, this program was around in the 60s, early 70s, resurrected a couple years ago, and that's how we created this opportunity. And put into perspective, why swim upstream when you can profit by working with the current? And that's what we're doing. We're partnering essentially up with the federal government, who recognizes that we are headed for a housing apocalypse, and that's why they've resurrected this program and are offering these terms that cannot be found anywhere else on the planet through any other program whatsoever. MLI Select, a turnkey investment. So what do we handle? What does our side do, and what do we bring to you? We handle the land acquisition, entitlements, site plan and design, the CMHC application, the construction management, the lease up and stabilization. That's right. We actually make sure the place is stabilized which means the lease money that is being generated covers all expenses. So you cannot take possession of something that isn't leased out and covering its expenses 100%, and ongoing property management. So earlier when I focused on that, we're not only with you at the start, during, and at the finish, we're there to see it cross the finish line. That's what I meant. You as the investor will not take possession of an empty structure and all of a sudden say, hey, I don't live there. What do? I don't even know anybody out there. None of those worries. Everything is handled. Introduction to property management, consultation, it's leased up, it's stabilized, nothing out of pocket. When you get the keys, metaphorically, this is in full swing, in motion, and you're just making money.
And this is really why I've formed this team or joined this team, is because not only are we bringing the best opportunities, better than other ones that I've sourced through other builders and groups, but they meet the criteria. But then this is helping the mom and pop investor with everything that is quite complicated and can be overwhelming. So this becomes a very straightforward investment where everyone's involved all along the way.
And when we talk team, don't just see the two of us. There's in every city that we work with, we have representatives that work with us, and they know the builders personally. They've vetted management companies. They have their thumb on the pulse of that market. So this is literally a cross-country team of people working together that share a common goal and help you achieve success in this segment. Okay, now, when we say mom and pop investors, the product, the majority of the business we do is in smaller product. And yes, we do have some institutional investors. A mom and pop will find it quite difficult to buy a 106 unit, $30 million apartment building that we're working on together. But the mom and pop has to have some assets already. So this program is designed for people who have established some form of wealth already, and it allows them to catapult to higher stratas of financial success and stability. And what do I mean by that? The qualification is quite different than any other mortgage the majority of you have applied for. You could personally claim a loss or make no money on your personal NOA, but your corporation might. And if you have assets and a net worth and cash flow, that is how you're qualified. So the majority of the qualification weight is placed on your net worth. You must have a net worth of 25% of the purchase price of the project or more. You must have liquidity of 10% of the purchase price. And in that liquidity, you must have 5% for a deposit. So other teams require 5 to 10% down. And then depending on what you qualify, you can get a cash back. We have fantastic relationships with our builders, and we only work for the majority of projects with builders who are building with their own money. And that's a whole different segment if they do it through this program that we're not going to discuss today, because the majority of our business is not through that. That's more for larger projects for us, but you need 5% down. So if you have 5% down, another 5% liquid, and own a home with net worth and equity that's already established, you should be able to qualify for these. And the beauty of this program, because it was created out of necessity to create housing that's much needed in the near future, once you qualify on one, you have a clean slate and your same criteria can qualify for another one.
Yeah, I was going to bring that up. That's an important point, because many of our clients have bought multiple properties, and the restriction we see on the residential investment side is that, it shows up in your personal credit report, and you eventually hit a threshold where it makes financing very challenging. Whereas with commercial, especially this program, it's based on the property.
Yeah, so the loan is actually placed on the property, and there's also limited recourse, which means as the years progress, first of all, you're going to be taking possession of this in a new corporation. Neither Ryan or I would allow you, or any lawyer would tell you to take it personally. Okay, but that corporation is new and it has no history. So limited recourse, which doesn't exist on the residential side, means you're only liable personally for a limited portion of that loan. And as the term progresses, it eventually gets to zero. So eventually you personally have no liability towards this loan, and it's strictly on your corporation. So there's that difference from the residential lending that you're used to. And there's also no 5-door policy like a lot of the big banks are. So a lot of the seasoned residential investors, they hit a wall at the 5-door mark, 5-property mark, and they need to find alternative lending to close on their properties. This doesn't exist through the program. So you could have an infinite amount of properties with limited to no personal liability recourse, all qualified based on your personal net worth and your liquidity, which is really the sky's the limit. And when I talk into later slides, you'll see how it's designed for you to scale up. Listen, I'm not a big fan of big government, definitely not the current government. Anybody that's hung out with me knows I became the person that stared at the TV, and sometimes I say some unpleasant things when I see them. But this is their Mona Lisa. And when it comes to real estate investing, and again, as a byproduct of protecting the institutions and the banks, you have the ability to catapult yourself and your family's wealth into a different zone that is not possible without. And you'll see how we can do that and the way we found to manipulate the system to benefit us. MLI Select summary. Okay, before we get into numbers. Government loan, up to 95% financing. Almost every single one of our deals was between 5 and 5.9%. 50-year amortization. What does that mean? It means your monthly payments are sliced in half, and that half that was going is now going into your pocket. 5 to 10-year term, all depends on the bond rates. Your decision is the final one, but we will provide our guidance based on our experience, and our bankers will too. Below prime interest rates, we're currently under 4%. All over social media, you've heard a lot of mortgage brokers saying, if you can get a sub 4% 5-year fixed, take it and run. Well, we're getting that or better through this program. Third-party cash flow sanity check. Your real estate investment consultant verifies them. CMHC verifies the numbers. The bank verifies the numbers. And then once leases are in place, they get verified again. And fixed price construction. Anytime you bought an investment property with us in the past, with either of our teams, the price was the price, and the builder had to build based on that price. And they could never come back and say, the price of lumber doubled, you owe me X amount of dollars. That is in place with this as well. It gets built for the price that it has been calculated. So that pretty much in a nutshell is the foundation of this program.
Right.
Okay, now I'm going to do a little bit of an example of leveraging, because there's another side to the investment world that doesn't really understand leveraging and is from a school of thought where financing is bad, it should be a temporary mean to an end, and you shouldn't over leverage yourself. And what that really does is it limits your potential for growth, and it's essentially puts a very big fish in a really small fish tank. A lot of fish grow infinitely up to the size of their ocean or their living environments. And you see a goldfish, and if you put it in a tank that's twice as big, it'll grow to twice the size. What we're doing through this program, because of the very favorable, exceptional lending terms, we encourage leveraging, borrow as much money as possible, finance as much as possible, and this really puts it in perspective. If a house costs $10 and it generates $2 a year in rent, paying it off means you have $10 tied up and the house is making $2 a year. Now, if you only put $1 down and leverage the 9, you might only cash flow 50 cents per annually. At first, that seems worse, but now you can buy 9 more houses and each cash flows 50 cents. So now instead of making $2, you're making 5. So by borrowing more, you're making 250% more. This is 2.5 times what you'd earn if you paid off just one house. So plus each house is gradually paying itself off over the amortized mortgage. That's what an amortized mortgage is. You're paying principal and interest together. In 5 years, you'll have built up $5 in equity combined in all of 10 houses. And now you can buy more houses, increasing cash flow even further. That's the goal, buy as much as possible. And that's really what the play is with this program, because the program is temporary. After 5-6 years, you could end up with 15 houses, cash flowing $750 a year and holding $30 in equity, compared to that just one paid off house, which would give you $2 a year and $10 in equity. See the difference? 3 times the equity, over 3 times, over 300% the cash flow. At the end of 5 to 6 years, you now have $62.50 in cash flow, and the equity from leveraging compared to $20 if you only own 2 houses. That's 420% higher return. And that's really how we build a portfolio as large as possible, by continuing to do this while allowable.
Yeah, that's great. It's a really simple way of breaking it down. And you know what? Some people are afraid of leverage. Robert Kiyosaki has a famous quote. He said, leverage is the reason some people become rich and some people don't. And, if you could ask, your wealthiest friend or your wealthiest friend's parents, how they did it, it's typically through leverage. The majority of people have done it through real estate and through leverage. But leverage can be scary. And in this market, I know a lot of people over levered and it's causing problems. But again, the reason why this program is so great is because it has all of these checkpoints in place so that you're meeting this criteria that is vetted by the government, vetted by the bank. So that you're in a position to be able to buy, repeat.
And that's the thing, and that's what I like to tell people. I'm like, you need to leverage smart, and you need to leverage within your comfort zone. But that's usually based on the train of thought that I am personally responsible for this debt. This debt you're not personally responsible for fully. And as time progresses, it becomes less and less of the onus of responsibility onto you personally and onto your created corporation, which was only created for this purchase. And that's what you need to think. So for the government to be insuring a mortgage with these, we'll call it what it is, insanely beneficial terms, and for a bank to be lending money at such a high loan to value, ratio, there must be safeguards in place to protect the banks, which then in turn benefit us. And that's really what it is. If you are going to go all in and push all the chips to the center of the table, this is the program to do it with. And I'm sure now that we've gotten into it a little bit, you guys are getting a better picture of it, a clearer picture. And by the end, you'll understand how we maximize the leverage and how the program is 100% designed for that. Next slide, Kayla, please. Okay, so let's talk numbers. You guys are here to make money. You're here to realize how to do it through a new vehicle in real estate. And these are the numbers. This is what we are averaging. This is not high, out of the ordinary, 1 out of every 10 deals. We've done close to 50 deals in the past year. These are averages, if not slightly below average, what we have hit number-wise. In Calgary, we're looking at a debt coverage ratio of 1.18 plus, and we're averaging greater than 18% returns cash on cash. That is a yearly return on your investment. In Edmonton, we're at 22% plus. These are real numbers. Now, Edmonton has been fairly insulated to what has happened to our real estate market nationally. They have not seen a drop. Calgary experienced a drop from about Q4 2024 to Q3. It started to balance out 2025. Every month we're looking at numbers. Every month we're talking to appraisers. Every month we're talking to property managers. And every quarter we adjust our estimated rents and how we calculate our numbers. So this is real world, real time. Like I said, our numbers are conservative and we are generating these or better across the board. So I challenge anyone to call us up and tell us about a real estate investment in Canada, because I know there's places in the States that might generate better, but I guarantee you that volatility is not what we're used to here and it's not comfortable for us, okay? I had someone, an investor from the United States. You can non-resident invest in the commercial real estate, so that's not forbidden. But this program, you must have Canadian assets to qualify. So he did, and he told me, well, I'm generating that kind of stuff in Brooklyn. And I told him to give me the address, and I Google mapped it. And I will tell you, I wouldn't visit that place after dark. And that's a great way to put it. So some of the areas that we work in, and this is just on a map, and I use Calgary because people are more familiar with Calgary. If you look at the pins here, places like Bowness, Montgomery, Banff, Braille, Capitol Hill, Tuxedo Park, Ross, Carrock, Radisson Heights. I like to use a site called Area Vibes. If it's copywritten, I'd like to say it's copywritten. Okay, Area Vibes. You basically type in a neighborhood and it gives you a rating and tells you all about it. Our neighborhoods, the lowest are about 76 out of 100, and they go up to about 85. And why don't we invest in areas with 90 plus? I'll tell you, the land acquisition is too expensive. And if the land acquisition is too expensive, your purchase price is too expensive, and your deposit is no longer 5 or 5.9, it could go up to 7. So what we try to do is we try to find that sweet spot where your area is fantastic, you get the most amount of rent, but your purchase price is also low enough so that you make the most money. And that's the most important thing here. If you're going to do this, check out areas that are high livability scores, but still affordable, because that's where you'll make the most. Okay, now this is kind of a visualization of the step-by-step. Of course, it's more intricate, it's more detailed, but this should wrap your head around it to at least be somewhat accustomed to it. And when you reach out to Ryan and his team, you can ask the right questions to help you along your journey. You put an initial deposit of 2.5%. It's fully refundable. That's done at the start of the due diligence after signing, and that basically gives some remuneration, some consideration to buying the contract. Okay, you get a 14-day cooling off period. During these 14 days, buyers has a right to review the details of the project. Sometimes they want to speak to a lawyer. They might speak to a lawyer that after. And when people tell me, well, why wouldn't I speak to a lawyer during the 14-day? Once you read our contract and see how many safeguards and escape clauses we've placed in, this is almost essentially conditional until the end. From a very unique, creative, and constructive way, which allows the seller to be comfortable, but also allows you protections and lets you sleep at night as well. Okay. You can also meet our banker during the period if you want, but again, the conditional period is technically indefinite, so you can do that after. At the end of the due diligence period, you put 2.5%. Okay. And the deal is firm pending confirmation of certificate insurance from CMHC. So the certificate of insurance from CMHC basically is a document from CMHC which says the project qualifies for the program. And then you, the buyer, qualify through the bank. And then the banker, when they pre-qualify, submits to CMHC. They check you out, they check the project out, and then you get your certificate of insurance, which is valid for 6 months. They used to be valid indefinitely, but last year CMHC put a time frame on it through this level of the program, through this avenue. So what we have to do is time it. So think about this. We have a construction project en route happening, and nobody can really create a concrete timeline for it because they're different contractors, different suppliers. We have the bankers doing their thing. We have the government. And when you ask a CMHC rep how long it'll take, they tell you 8 to 16 weeks. So look at that time frame. And then we have the lease out after, which nobody can calculate. So when we say it's hands-on, all hands on deck on our side, this team that you've hired to represent you, everybody's doing their own part to decrease the variables as much as possible and try to fit everything into a 6-month window. Okay? So after the application, it takes about 3 or 4 months to get your certificate of insurance. Construction continues throughout this entire process. Usually takes about 7 to 8 months, depending on weather, and then your final closing. Your final closing occurs after stabilization. So that's when the marketing team, that is when the management team, that is when they are working together to get it leased out. And then once stabilized, which means it is not costing you anything out of pocket, that's when you get your keys. That's when you start paying for your mortgage. So in between start to finish, how we have there from signing deposit to the other 2.5%, which means you're 5 in, to all the other steps up until it being rented out, you're basically called on to do XYZ, back away, called back to do a little more, backed away. It's really, think of it as HIIT cardio. When the treadmill turns on, you sprint, and then when it turns off, you rest. But the majority of the work is done by your team, and that's why you've hired us. As much as a handoff investment as possible.
What has been the average time frame for the deals we've been doing?
We have some that are already in construction, so our quickest one is going to be about 6 months. And that's really, if I had a project that was built today and I said, Ryan, I got this really good deal opportunity for you. Let's fly down, take a look on it if you want. We lock it in. You love it. It's already built. They start renting it out. We usually tell people we can't complete the process in less than 5 to 6 months. And that's not us. It's not you. It's just the amount of time that you need when you're working with a banker, appraisers, environmental surveyors, and the government. And then the subsequent lease out. Like even if it was leased out, you still need about 2 weeks to 3 weeks to get your paperwork submitted and reviewed by the bank. Appraisals can take up 4 weeks, maybe 5 sometimes. Environmental, similar. And then you got to package everything together, submit to CMHC, and that can take, the fastest one we had was 8 weeks. The longest one was 16. Hello? So, points here. Deposit is fully refundable. If for some reason you don't get your certificate of insurance and your funding from CMHC, well, insured by CMHC and the funding from the bank, you get your money back, okay? Our program usually qualifies between 5 and 5.9%. There are exceptions, but if something changes, if rents drop substantially, or if prices change or market conditions change, I guarantee you this is the only real estate transaction where your investment consultants go back to the builder, the seller, and renegotiate a lower purchase price. And people might think this is unheard of. We did this 8 times last spring. We proactively saw what was happening to the Calgary market. We capitalized on it for our investors. We personally called in appraisals. And then we went back to sellers and said, the price needs to come down anywhere from 80 to 160,000, depending on the neighborhood. And we lowered purchase prices and send amendment to our clients and say, we just saved you X.
Yeah, that's great.
And it's not something that, it's not a magic trick or an illusion. We have criteria and safeguards in place. And if they're not met at the end of the day, this project doesn't work. And then the builders built something and doesn't get paid. So it is in their best interest to play ball with us. And we do this to protect you and make sure that this works out as planned. Yeah. So the deposit stays in a real estate brokerage trust account. Now, this might sound as like an obvious for those of us in Vancouver and Toronto, but in Alberta, it is quite common for deposits to get released to builders for them to build. And that's why I explain this, because what is every day for us is not for someone else in another region. So in the vast majority of our transactions, your deposit stays in the brokerage trust account, an insured trust account, just as if you were buying any other resale property until closing. If you're going into larger purchase price, larger big ticket items, 20, 30, 40, 50 million, they're financed through a different avenue of this program where the deposit is released, but it is fully insured and the insurance has to be reviewed by the bank. It's mandatory by the bank and lending institution. So for the majority of our investors watching this, their deposit will be held in trust and they have nothing to worry about. And if it is ever released, it is fully insured. And it's not us demanding this, it's the bank, okay? So purchase price renegotiated. I talked about that earlier. If there is any significant deviation to market rents, market purchase prices, or any significant change / act of God in a region, okay, or economic decline significant, we must renegotiate your price or the project will not qualify. Remember, the qualification at the end must match or be very similar to CMHC certificate of insurance that was based on your financial projections. Special incentives. We get free appliances for every unit. So every unit, every project is rent out ready, occupancy ready. Your tenants don't have to do anything aside from curtains or blinds. And the reason we don't do that is because too many people have their own version of what they like. So we thought we would do everything else possible and then you can do it yourself. No cost escalation. The price is the price. And no matter what happens to the construction cost, they stay. Full new home warranty. In Alberta is mandatory for pre-construction to have a new home warranty associated. It's not through the province as if similar to Tarion as if we have here. It's through private insurance, but it actually lasts a duration of 10 years as opposed to 7. And the first year is essentially like a bumper to bumper. In-house initial lease out or property management, we ensure that the property management team leases out to stabilization before you take possession and turnkey delivery. Once it's stabilized, you get the keys and there's nothing else for you to do. It's in full motion. And these are the 5 incentives that we offer, in addition to contractual protections, which are second to none in the industry. We know this because we've seen our competitors. And in the end, the vast majority of buyers end up with us because our contract is to protect them. Before we get into numbers, to put into perspective, we've had 134 projects cross our desk in 14 months, and we've opted to sell just under 50 of them. So for every 3 almost, we push 2 away because they don't match it. They won't agree to our terms, or the numbers don't match what works for us. Here's an 8-plex in Edmonton. I'll give you an example. Our upper 3-bedroom unit, we're using $2,250. One of our competitors is shamelessly putting $2,400, even though the rents right now are around $2,250 to $23. Some of his have up to $2,600. That is currently unattainable, and it will run into problems, our clients, if they use those. Our basements are $1,000 here. We use $1,000 to $1,200, depending on the neighborhood. Your affordables will be the $1,000 to $1,200, but your non-affordables can go as high as $1,400. When you look at expense projections, these are not numbers that we've created. These are CMHC benchmarks. So the numbers that you see are mandated by the program to be used. So what we do is we amass the best data available, use that for what we can plug in, and then for what we can't, we use the government numbers. So what you see here is a combination of research and what we're mandated to use. And even if we change those numbers, CMHC would cross them out and use their own. So you need to use this. You need to be thorough. But more importantly, what we see here is we see a cash flow of 16% on this, and we see our DCR of 1.17, okay? That is a bare minimum. If it is saying 16%, expect to get 18% or better. We've just recently revised this to be a little bit lower, and we've come to an understanding of what we're going to do is we are going to be ultra conservative on the submission. Why? Because that guarantees you'll get 5% down, if not 5.1. So what people need to understand is we'll show you what the rents are actually being achieved. We'll drop them a little bit. This is designed to guarantee that you get in for as little money as possible. And then I'll explain once we do that after, because if you're estimating at 2250 and you do get 24, in a couple of slides, I'll show you why we do that and what you're going to do. Calgary, similar, 8-plex, okay? Think of Calgary being an extra third on top of the cost, an extra third more rent than Edmonton. So where that purchase price was 2.2, this is 3, okay? Where that rent was 2250, this is 2600. Our competitor has this similar type of project for 3,000. That's a very, very big delta between the two numbers. We're at 1,400, they're at 1,600. Our affordables are 14. You could probably get 16, but you're not getting 14 for affordable. That's why we put that, okay? Again, benchmarks are in there. Cash on cash 18, DCR 1.21. And again, these are undervalued. These are conservative. If you see 16, 18%, expect 18, 20% in reality. If we go to the next slide, can this opportunity get better? And this is why we underestimate our applications and submissions. Pari passu. I'm big on Latin terms, and I only use those as opposed to Greek ones because Greek's not as commonly understood as Latin. Pari passu is Latin for meaning side by side or equal or similar footing, okay? In the world of lending, it basically says you can borrow a secondary mortgage or secondary financing on the same terms as the first. So, an example, you are getting a property at $3 million. You're getting 95% financing. So you have $150,000 deposit and you're getting a loan amount of $2.85 million. If you overestimate the rents, you have to play a certain amount of time to catch up to actually get to those rents. I won't get in that you might have to put extra deposit down and all that, but we don't do that, so it doesn't apply to us. but just trust me, there's a whole different episode I can do on the pitfalls of not doing this properly. But if you do it properly and you estimate $2,600 on rent, and then we actually get you $2,800, as soon as you have a 12-month rent roll, you can pull a new appraisal and show that the value of your property has increased in value. This program allows you to get a second mortgage through a pari passu similar footing. So now you have a second mortgage, pulling out all your original deposits, so you're in for zero down. And that second mortgage is on the exact same terms as your first mortgage, and it piggybacks it. So now you're at 100% financing, and you're making all your profit with no money out of pocket. You take that money and you buy another one. So now one became two. And you keep doing that till eventually you stop. But in the meantime, you own all these properties that are fully financed with none of your own money down, and you're making money 100% on the bank's money. And that's really the beauty of this program.
Yeah, and that's buy, refi, repeat. That's how people build and scale portfolios. And that extra $200 a month across 3, 4, 5, 6 units may not sound like a lot, but that's actually how they appraise the value of a commercial property. It's based on the cap rate and the rents, but that makes a significant difference. Do you have an example of like what that would boost in terms of the appreciation?
Well, if we go back to that slide, the Calgary slide, Kayla, okay? If we look at 4 units at $200 a month, okay, so $200 times 4 is $800 a month, times 12 is $9,600. What's our cash on cash? Okay, so take 26,597, add 9,600, and what's our total?
You're asking me to do that.
I'm asking, I was getting Kayla to do, but you can do it live and then divide it by your deposit.
Give me the numbers.
26,597.
Yeah.
Plus 9,600.
Yeah.
Divided by 151,250.
151. I think my math's wrong. I have 23.93.
So you're at 24% cash on cash. So you've increased your cash flow.
Yeah.
You've increased your cash flow by 25% with $200 a month just on your uppers. So there's a 25% cash flow increase, okay,
right,
which would fall in line with an appreciation of greater than your 5% that you put down, which would allow you to still maintain a 95% financing ratio, but with $0 down personally.
Yeah, it's awesome.
And here's the thing, that extra $150,000 in debt would be about $600 a month, okay, in debt load. So you would be making $200 a month more profit, but you would be in for $0 down.
Right.
So you'd make $2,400 a year with none of your money invested, as opposed to $150,000 invested. And that's the beauty of this program. And you just repeat.
It returns at that point.
Infinite returns. And this is like, when I say this, and it blows a lot of people in the way, and they take a step back, they lean back in their chair and like, yeah, right. But this program, if maximized, and you didn't have a definite timeline with product availability and rent returns and scarcity of product and stuff like that, this is a pathway to becoming a billionaire. And a lot of the families that tackled and went full on in this program in the 60s, a lot of them are real estate billionaires across the country.
Yeah. Well, I mean, this is what Grant Cardone talks about as well, 10X. It's like once you have a portfolio at a critical mass at a certain size, you're then looking at selling that to institutional investors. I mean, I know someone he's in the West Coast, mainly invested in Edmonton. He's accumulated 6,000 units across Western Canada, and he's now shopping that around to REITs who will buy that at a massive multiple.
And that's what it is. And a lot of REITs have a non-construction mandate, and we're actually working with some as well. And I'm happy you brought that up. And people are like, well, where's the end game? And say I buy 10 of these over the next 5 years. And I said, well, if you have 80 doors, then we can approach a REIT and they will buy it, because for them, it's just a spreadsheet, but they're not allowed to partake in construction. So they're waiting for somebody like you.
Yeah. Yeah. Huge opportunity.
Yeah. So here's the warning. And I think I've spoken to all the positive, and this is really what I think sets us apart. Unlike others, I'm going to tell you what to look out for. And Ryan and I are very similar. That's why we work together. We're not scared for you to go talk to other people and then come back to us. And we know you will. And why is that? Because anytime you hear any of these three things in bold, caveat emptor. And that's really following the Latin theme right now. And it means buyer beware. And as an investor, anytime you hear any of the three, have your guard up, and I'll explain. Rental guarantees. If a financial projection is accurate and thought out and provided with the best information possible, why would they need a rental guarantee? Now, what does a rental guarantee do? If you're artificially inflating rents, and rents are the tool that they use to appraise and value your product, the rental guarantee artificially inflates the price of your product. So you're leveraging more money and paying more money and getting more indebted than you need to. So anytime you hear rental guarantee, you're getting scammed because you're paying more than you have to. And depending on what type of CMHC MLI program you venture down, future audit potential does exist. And if they audit you and it doesn't make sense, or if anything is questionable, it is not unheard that the government to pull back some of the loan and you need to increase the down payment. So be very careful. And in my mind, I can't see why anyone would want to pay more and take on more debt than they have to. And again, if you're overinflated on your mortgage, how are you going to pull out your deposit to reinvest it? You won't be able to, because you'll always be behind.
That's a great
Deposit release. For smaller projects, there is no reason why your deposit needs to leave and be released to the builder. None. The only time that should happen is for larger projects where it's part of their construction personal owned financing, where there needs to be some consideration instilled by the buyer for multi-million-dollar projects because of the amount of money they're borrowing.
And even in that case, we're putting bonds in place to insure them so that
there's bonded insurance. And our lender, we actually work with the VP and upper management of one of the top 2 banks in the segment. Okay, they mandate it and they handle the insurance process for you, because it's not just your money but their money that's being insured fully. Okay, so for the entire process, you have nothing to worry about. And overinflated rents. Again, if you have overinflated rents and the rents don't come close to what was forecasted, depending what program you're using exactly, because there's all intricacies, you may have to either put more down payment, you may not qualify, and your investment was basically wasted for a year or two, you didn't make any money on it, or in the future, they might take back some of the loan and you'll be forced within a short time frame to put a large cash injection. So listen, any of those 3 things, spidey senses start tingling. Now you know why you should be worried. Your gut will tell you that. Now you know why your gut's tingling and you got those butterflies. But be very careful. You don't have to use us, but I guarantee you, do not use anybody that offers these things. Okay, FAQs. We're going to end on this. When do I start paying for the loan? Through the vast majority of cases, you pay for the loan when you get the keys and you're the official owner. Why do I see so many Alberta packages and very few Ontario? 1, landlord-tenant rules. In Ontario, in places like Ontario, Quebec, BC, it can take you up to a year to evict tenants, sometimes longer for non-payment of rent. In Alberta, it can happen as fast as 14 to 28 days. Okay? Median household income. Highest in the country, Calgary and Edmonton. Not much different between the affordable and the non-affordable, to the point where basement rents are at par. So you put affordable component in the basement, you're not losing any money through the affordable component. Not the case in the other major cities. Okay. When do I take full possession? Oh, in addition to that, sorry, Alberta does not have development charges and it does not have land transfer tax. So you end up closing with very little money at the end, and it actually costs a lot less for the builder to build, which means you buy for a lot less. So those are the main reasons why we're focusing on there. In addition, and finally, that we are very bullish on that project for future growth, not only growth of economies, but growth of population. When do I take full possession and how do I take possession on an empty building? How am I going to find tenants? I answer that, but in case there was a lot of information you guys forgot, you do not get possession of an empty building. You get possession of a stabilized building, which means there is enough tenants in place that the rent being generated covers all expenses. You only take possession at that point, and then you might have 1 or 2 units of an 8, and that's all profit anyways. And no one can ever complain because there's no other investment where you are guaranteed to have tenants in place and it's not out of pocket. Am I locked into this program for the 10-year term? Exit options. The program insists that the property have the affordable component for 10 years, whether you have a 5 or 10-year mortgage, but you can sell it as long as the new buyer qualifies the way you did and the mortgage is transferable. So the reason this will be appealing in future to sell is because of the mortgage. We are buying property to get our hands on this mortgage. Again, I said from the start, this is a leverage play. So the property is secondary, the mortgage is primary. That's our focus. We're getting this loan, and other people will want their hands on this loan when we go to sell it. So that's what we have of value, and the new buyer just qualifies the way you did. And what's the catch? The catch is that, like everything in life, this opportunity has a finite amount of time. The city of Calgary and the city of Edmonton had blanket zoning for the past couple of years. And what that meant was, as long as you could fit 12 units on a property, you could build up to 12, no committee of adjustment. New mayor in Calgary, first thing into December was an impromptu vote. They voted that in the spring, they're going to cancel, repeal the blanket zoning, and anything that hasn't already had plans submitted is going to have to go to committee of adjustment. So we have a limited amount of supply in Calgary. Edmonton has been teeter-tottering on this for the past year. If they shift over, aside from that, we have the government 2 to 3 times a year constantly fine-tuning to take a little bit of money out of your pocket and put a little bit back in theirs. If you're going to do this, let's aim for until the end of the year. That's when we can kind of guarantee everything. And after that, we can play day by day. But really, our teams, we're focusing on the next 10 months, do a good push, maximize as many deals as possible, make as much money for our clients as possible, and then look for new opportunities after that.
That's great. Awesome. Yeah. And if anyone wants to get in touch, take out your phone, scan the QR code, and we'll be able to share all the financials with you, the different properties that are currently available that have all been vetted, rigorously vetted properties with all of the incentives and everything that Kostas mentioned. You did an awesome job there because these are big ticket price transactions that tend to scare people, right? But it doesn't have to be as complicated as people think it is. And that's why I'm really happy to have you guys, to be working with you guys as a big team, to be able to offer all of these incentives, the great properties, and really well done at just kind of simplifying it and really laying it out for everyone. So I appreciate it, buddy.
Thank you. Pleasure was all mine. I'll see you in a couple of days. And again, I look forward to working with everybody. Thank you, guys.
Thanks, Kostas.